Before we dive into the video, I'd like to explain how our videos work. The purpose of this segment is to empower freelance investors to take confidence in their investment journey. We aim to package information about the market in a way that everyone can understand. We will generally link the events that happen in the market to specific trends. We will indicate how we think investors should think about these trends when making their investment decisions. To this end, we will highlight specific sectors that are expected to benefit from these trends. Once our audience is aware of these sectors, we anticipate that they will look into specific companies in these sectors to evaluate which of these companies they would like to invest in. In the Easy Equities Explained video, we provided key steps that a freelance investor would take in evaluating specific companies using Amazon as an example. We would like our audience to use these lessons that we provide in each of these videos and feel confident enough when making investment decisions. We do not provide a list of companies that people should invest in. Rather, we provide key lessons that can help you come up with your own list and to do this with utmost confidence in the decisions that you make. The theme for the macroeconomic update this week is inflation, which has been top of mind for most investors. If you've been around for a while, we explain the link between inflation and how central banks use interest rates as a tool to control inflation in episode 2 of This Week in Markets. Last month, as inflation was seen to be moderating, investors were hoping to see the end of the interest rate hiking cycle. After this update, investors are worried about the possibility of sticky inflation and a longer rate hiking cycle, specifically for the US. Good news for the UK, as the annual inflation rate continued to moderate in January 2023. This is the third consecutive month where the inflation rate has continued to fall. It is, however, still at the highest levels it has been for 40 years. The decline in inflation was driven by a drop in petrol and diesel prices, as well as moderating travel costs. Moderating petrol and diesel prices is incredible news for any country, but with double-digit inflation rates, consumers are still under immense pressure. In January, US inflation slowed down slightly to 6.4% from a year ago. This was only 0.1% lower than December 2022. The Fed had indicated that they are watching the inflation data and the employment data very closely for their decision making, and at the moment both are indicating further interest rate hikes. Remember that aggressive interest rate hikes can tip the economy into a recession. Recessions are usually not great for equities, so investors are keeping a keen eye on this. On the local front, annual inflation rate eased for the third straight month to 6.9% in January 2023, from 7.2% in the prior month. This was in line with expectations. The inflation rate remains above the upper limit of the South African Reserve Bank's target range of 3% to 6%, but investors are relieved that it is getting closer. The concerning thing about this print was that food and non-alcoholic beverage inflation remained incredibly high and accelerated in January. This means that the cost of living crisis is worsening, and consumers are facing a lot of pressure. Load shedding is to blame for this, as it impacts the price of refrigeration, as food retailers have to secure alternative sources of energy that comes at a cost which is passed on to the consumer. All eyes are on what the Reserve Bank will do about interest rates, since South Africa is seeing good news on the inflation front, while the US is not. Another data point that was published this week that gives us insight into what the average consumer is going through is the December retail sales. Retail sales declined by 0.6% from November. Remember that November would have captured Black Friday sales. Annual retail sales were up 1.7% for the 2022 year, which isn't too encouraging. Consumers are not flocking to the stores in numbers. Remember, as we have indicated previously, when the trend of consumers being under pressure prevails, we should look at investing in defensive sectors like healthcare. In addition to that, because of the unique position that South Africa finds itself in with load shedding, we should also start thinking about getting exposure to alternative energy providers. On Thursday, South 32 reported a 34% drop in first half profits due to easing prices for its key commodities and higher inflationary pressures. The company is also in talks with Eskom to secure nuclear power for their aluminium production in South Africa, as their European customers are willing to pay a premium for green aluminium. The share price is up 20.39% so far this year, as it is one of the mining companies expected to benefit from China's reopening. The share price only moderated slightly on Friday as a result of the interim results announcements. These results were in line with what investors expected, and the company kept the same expectations for their production in the coming year, which explains why the share price didn't react aggressively to the results. Glencore, on the other hand, has reported record full-year earnings driven by high energy prices and the Ukraine war. This highlights how trading companies have been among the biggest beneficiaries of the energy crisis. Glencore's net income for the year attributable to shareholders was up a record of 248% versus 2021. What? The outlook looks particularly lower than these record earnings, as coal mining, or rather coal prices, which have supported these results, have dropped recently. This is due to a mild European winter and high stockpiles leading to reduced demand. African Rainbow Minerals published their trading update for the interim period ended 31 December 2022. Management indicated that they expect headline earnings to increase by 34%, or between 34% and 44% year on year. This was mainly driven by higher earnings from their coal and manganese operations. Despite this, the share ended the week 5.5% lower. The share has not performed so well so far this year after a great performance in the second half of 2022. Life Healthcare published a positive trading update for the 4 months ended January 2023. Their SA South African operations are seeing an improvement in admissions as they recover from the COVID years. They also indicated that they are considering multiple unsolicited offers for their UK-based diagnostics business, which is one of the companies that stands to benefit from ongoing research into Alzheimer's disease modifying drugs. The share price was up 13.86% on the day. This update also benefited the net cash share price. Telkom, on the other hand, announced this past week that it plans to retrench 15% of its staff. This plan will impact about 1,800 employees and will likely add to South Africa's already high unemployment rate. Unions are reportedly outraged by this announcement. It is part of the company's restructuring plan. in order to reduce costs. They also reported their trading update for the quarter ended December 2022, where earnings before interest, tax, depreciation, and amortization was down 13.5%. The share price is up 4.4% this week as investors welcomed the cost-cutting initiatives. Now, this brings us to the end of episode 5 of This Week in Markets. I am Billy. All thanks to Zoe and the team. We'll meet again next week.